Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. As always, guys, we have an economic black hole brewing. I know the charts are up, crypto's cranking. We're going to talk about both those markets in today's video and why you need to be looking out for what's below. Let's dive in.
Trade Genius.
Hey guys, we got Black Friday specials. They're really cool. We have the best pricing for the year. You can get our basic package, our advanced packages, our VIP rooms, software, trade options, trade crypto, trade the futures. With us, get our indicators, best prices of the year. Take advantage of it. Thanks for listening.
Okay, Bob. So, markets have been enjoying a pretty good pump here in the last week or two. Crypto especially, has been cranking. It feels like another round of 2021 upon us. But, if we start looking at the data underneath, we're going to start seeing that I think things are starting to get a little wobbly, let's say. What do you think?
Yeah, we had probably the biggest reversal in sentiment, I think, in a long, long time. And the data is stacking up. The charts we're going to show you today it's just one thing after the other. And look, I don't care what anybody tells you, the stock market can only go up if there's liquidity and there's bank credit in the systems. And we're going to show you a number of charts to tell you that basically everything's leaving the ship right now. And I feel like we're in a Looney Tune cartoon where everything's falling around and the guy's still standing there in midair. And I think bad things are going to happen here, Phil. So let me show you the first chart. Let's put this thing up here right now. So the sentiment reading, look at this. It was getting really, really bleak. And then they went ahead and they threw that bomb into the markets to lift it right into resistance here. We filled that gap and they pushed it up Friday. And then Friday we had that crazy Moody's report. Market opened down, but we're in OPEX week. So, you have a lot of people now selling puts underneath this market. I think that's what we got to explain to people. You have a group of day traders, institutional day traders. They're not taking positive positions. They're taking sold put positions underneath the price. And their goal is to make it to the end of the day. But when they sell puts like that, they force the market makers to buy futures. So they create these lifts every day. And their goal is to continue to extract out liquidity. And I think the next chart you want to show, if you have that chart, you want to show, retail investors are leaving the markets here, highest rate ever. I think two things are happening. One is people are sick of losing money. Remember, the average stock investor is down 18% this year. People don't realize that. People are losing money in the stock market this year. You look at the indexes and everybody's talking about how great the stock market's doing. People look at their 401ks, they don't see it. Right. The other thing people don't see is enough money to live off of, so they're canceling their 401k plans or rating them at fastest levels ever, Phil. Okay, and then their credit's drying up, so they don't have money to play with anymore. So they're basically bailing out. This is ominous because institutions they require retail to be the bag holder, and this is going to be the second time where the retail gets out ahead of institutions. And when that panic sets in, it's Katie bar the door, Phil. What do you say?
Yeah, and I think the part of the problem too is that we have credit contraction, and whenever we have credit contraction, it's going to hit retail, and so we can see that too in the bank credit chart here. This is all commercial banks. This is pretty significant, guys. This is only the second time in this chart's history that we've gone negative year over year in bank credit. So, and this is by design. The Fed doesn't want economic expansion right now. They're trying to get this thing curtailed in terms of getting the inflation down, but this is a significant drop. Now, if you guys look on the chart here, these shaded areas are all the times that we've had recession. And if you noticed when that happens, what do? We go from a year over year credit of say 10 to down to 2.5% change year over year, positive change. Well, here we are, we've done that already, and now we've gone negative. And so you're telling me that we're not in a recession? I think we are. And this is 100%, guys. This doesn't just, drop down to these negative levels to below 2.5 and you don't trigger a recession. Every time you drop down toward that 2.5 mark, you're getting a recession. And so we just don't see it here. And I think that's a big problem. And I think we're going to start seeing the data. And where we're going to start seeing the data is going to be in jobs and things like that. But before I get to that chart, we also have to look too at the money supply contraction. Again, this is by design. There was too much money being printed. I don't have the M2 chart itself up, but if you guys saw it from COVID till now, a massive spike. So we're seeing massive changes in the M2%. M2 is just a measure of how much dollars are in the system between everything from retail savings to institutional accounts. So there's a broad measure of the dollars in the system, you don't get this type of contraction and not trigger a recession. It just doesn't happen. So then you also have to look now at job openings, and that's been the more recent decline that we've been dealing with. And you have to look at the rate of change in the decline of job openings. Now you can say like there's a lot more job openings here than we had previously, and that's true, but it's the rate of change that you want to see. And as you can see, the rate of change here is as steep as we've had in every other crisis. So, and I think the job openings can actually fall a lot more, which is kind of scary. So I think you're seeing just a ton of stuff here in the macro, in the fundamentals that are pointing to the fact that we probably should already be printing a recession in the data. And it's just, the government's just not doing it yet at this point. And I think the fudging of the data in the government from the government side is as high as it's ever been. The adjustments and this and that has just been ludicrous. I think when you look at like the birth death rate adjustment in jobs, it's just stupid. The household survey, I want to see the next household survey, Bob, because I think that one's a really honest indicator of job loss. And we should get another data print in a couple of weeks. And I think that's going to be very telling as to the real state of things.
Yeah, I mean, there's a couple things here. Number one is with jobs is that a recession indicator is when the percentage time, they look over 15 weeks, people who lost their job getting back a new job. And that hit recessionary levels. At 15% is recession. We're at 28%. The other thing too, Phil, is that, these numbers are totally fudged. I mean, look, they're telling you that healthcare is not a contributor to inflation, which everybody would just laugh them out of the room with that.
Right.
And jobs are a lagging indicator. Shipping is number one.
Yeah.
Okay. Shipping is collapsed.
Right.
So so I totally agree with you. And guys, the reason why we're not showing negative economic prints is because of the inflation level. Okay, inflation is hiding, it's masking it, but they can't mask it anymore. So I think in October they're going to officially say they've hit the recession.
Yeah. And then the other thing, this isn't just affecting the macro stock market too. This is going to start hitting crypto. I know a lot of our followers are into crypto, and so I wanted to touch on that real quick too. Just kind of touching on the whole, basically looking at Bitcoin and looking at it in terms of this is open interest down here, guys. So this is how many positions are open or not open in the market. And usually when open interest gets really high, we end up getting tops in this market. So quite simply, I wanted to show kind of like where we've come from, right? So we had our all-time highs up there near 70,000, and you can see open interest was way up here, over $21 billion. But what you have to keep in mind is open interest isn't going to go back to these higher levels when M2 is declining, a rate of change is very steep in its decline, and you have these other things like credit contraction going on in the market. So you're just simply not going to have the liquidity to get back to the required open interest levels that are going to drive these markets higher. And what I wanted to point out to you guys was, even though we've had really good moves up since the beginning of the year, it's really since the last market lows across the board in 2022, at the end of 2022, right? We've had this extended move up. I would consider this more of an echo rally or maybe a lower high in bear season. And the reason for that is if you look at where open interest is right now, whenever we get to 14.5 billion in our current market, this is just current liquidity situation, we're topping out. And so you can see it back here when we had our subsequent rally from the initial dump down, we came up to about 46, 47,000. And if you look at open interest, exceeded 14.5 billion, and then very large drawdown from there. And then if you look at our pushes where we've really pushed up high, we get to that open interest of 14.5 billion up here. This happened in April. We got up to about that 30, 31,000 area, and then we pulled back down into 25. The subsequent rally didn't even get that high in terms of open interest, and then dump back down, and now we're back above where we are, and we're hitting that 14.5 billion in open interest again. So what we're seeing is leverage helping to propel this market higher, but ultimately we're getting back to that choke point as far as what else can be open in terms of open interest and trying to get this market to push higher. And I think we've maxed out. So basically open interest down at about 8.5 billion has been our floor. So if we do pull back, I'd be watching this open interest level for support and maybe another bounce back up off of that. But for right now, guys, as far as crypto goes, we're going into this big resistance area. Remember, this is where Luna broke down. A lot of times the markets will seek out those old liquidation breaks just to kind of repair the tape, if you will. But if you notice too, when we pushed up and got to these open interest levels previously, what were we doing? We're going back into major weekly resistance, previous liquidation breaks, and it was proving to be massive resistance. It took the third try to break through this resistance, and this resistance is probably not as severe as this resistance that we're going into. So I don't think the markets are magically going to waltz through this level. level, especially when we have things contracting like M2 and credit and yada, yada, yada. So I say enjoy the pump, but recognize where we are in terms of structurally and liquidity wise. And I think things are getting tapped out here. So probably due for a pullback. Maybe we'll get another try at a bounce as we get closer to Christmas. But I don't think you should be too exposed to the long side here in things like Bitcoin and the stock market, because although it looks rosy, and the price action too, Bob, today, I mean, if we look at what happened with the bond market, price action today in the stock market, it was very jittery. It just reeks of like a lack of liquidity. And that's where we can get some pretty sharp drops. And then we got CPI tomorrow too, Bob. And if that comes in hot, we could have a significant drawdown in the markets, I think, just because I think those downside hedges start to increase in value, and then dealer hedging has to come in. And it's sort of a self-fulfilling prophecy if we do start to pull down.
Yeah, and look, and the trick to watch, guys, with these zero TTE guys is that if you do get a break of -1% to 1.5%, during the day, then the dealers are going to hedge to the downside. Just keep that in mind, because that's where the bid is. The bid is in sold puts, and so that's how they're lifting the markets. So just be really careful. Look, everybody talks about the Santa rally. The Santa rally is after Christmas to New Year's, guys. Just FYI. Whatever this stuff is just year end playing catch up and institutions trying to make their number, but they're definitely subjected to market events. And look, one other thing that we didn't talk about is bank credits now, but bank lending went negative. It never goes negative. Banks cannot survive if they don't lend money. Okay, and with the RRP being drained down, all banks are basically holding companies of treasury bills and treasury bonds. They're like a new entity, and that's kind of scary. And so a lot of things are going to be breaking here soon. The smartest money, people way smarter than us, says look for a break between January and March. We don't necessarily disagree with that, but the market does not necessarily have to go up higher here. People are talking about 4,600. I don't know how the hell they get there, Phil, when there's no money coming into the system and the Treasury is extracting hundreds of billions over the next couple of months.
Yeah, Bob, I think the only way it would be very short term. It would be T-bill driven with reverse repo drawing down, and reverse repo is drawing down like day after day after day. Like we've never seen that before. And you and I looked at that, and at the rate of change, actually people are saying April. I disagree. At the current rate of change, we'd actually be down to zero sometime before the end of February. So it's pretty wild.
Yeah, and it's not just the T-bills that are doing it. People are extracting money too, because you get a better deal with a money market account than you do with the Fed. So the banks are moving away from it too. So I think this thing could draw down between December and February. I totally agree. And then the slush fund is gone.
Right.
And we haven't even talked about maybe the government shutting down between now and the end of the year too. So that's going to be another drag on liquidity and economic activity too.
Yeah, so I would say that we need to take a look at what the reaction is to CPI tomorrow. If it comes in hot, I expect a pretty good sell to come into the market, and then we'll just see where we go from there. But a lot of people are banking hopes on a Santa rally. That's going to really depend on where we end up post CPI. If we're dumping below 4,300, it's one of those situations where selling begets selling and buying begets buying. And 4,300 is a key level for more buying. Under that, then I think you have to be very careful to the downside, as we could go back down and take out those recent lows. Even though we had such a really strong rally, I would say it's been more short covering than I would say buying. And I think the liquidity picture would tend to agree with that.
Totally agree. So guys, if you like these videos, hit like, hit subscribe, hit the notification bell. If you like how we trade, maybe we should show you sometime this week how our indicators work, because they love this market, because we're getting volatility, and that's how you make money trading, when the market's volatile. So, with that, Phil, that's all I have. You guys enjoy your week. We'll catch you tomorrow.
Take care.
Trade Genius.